top business stories live from the Sky News City studio. Mercer and Smart Pensions join forces to provide modern pensions technology to employees in smaller companies. The last of the big three Detroit car makers poised to settle with striking workers. And why this year's graduates may be finding it tougher to find a job. Good afternoon, this is Business Live with me, Ian King. It's now 11 years since auto-enrolment was introduced in the UK, the requirement for every employer to register eligible employees into a workplace pension. But managing that is easier for the public sector and for larger private sector employers than it is for the UK's 5.5 million small and medium-sized businesses. Well, it's with that in mind that Smart Pension, one of the UK's leading workplace pension providers, has today joined forces with Mercer, the global retirement solutions giant, to support such employers. Well, with me now to talk about this are Phil Parkinson, he's UK Investments and Retirement Leader at Mercer, and Jamie Fiveash, Chief Executive at Smart UK. Gentlemen, welcome to you both. Jamie, let me start with you. What are the biggest problems that SMEs have when they are enrolling employees?
Well, I think firstly, with SMEs, they've obviously got a business to run. They're small businesses. They haven't got a provision of, big HR departments and payroll professionals. So really, it's trying to make things as easy as possible, and we think technology enables that to happen. So at Smart, we already serve around 60,000 SMEs, and it's through the provision of our technology that we're able to make that easy for them. And I think most importantly as well, make it easy for the end consumer in terms of being able to use apps and so on in the way that they're used to through other industries. And that's what we're looking to transform. And especially working with Mercer. So
when you're looking to provide technology solutions, then that means what, enabling employees to be able to see how much they've saved at any given time?
Yes, exactly. So on an app, you can log onto your app, you can see how much you're saving, you can see your pension contributions come through, and you can also see your investment performance and how well your fund is performing as well.
So Phil, what will you be delivering here?
Yeah, look, as Mercer, as you said at the start, Ian, as a global sort of provider, brings a lot of scale and distribution. We manage just shy of $400 billion of assets for clients around the globe. And I think scale is one of those challenges that small and medium enterprises have, getting access to the right investment solutions, but also at the right price. So ensuring in this day and age where many of their employees are under a lot of pressure from a cost of living point of view, that they get access to quality, but at a price point that helps them save for their long-term future.
And presumably this will also, at the moment, if you're in a big scheme, then you can have a certain amount of say over where your money is invested. So if you want to cut out oil and gas, you can do so. Presumably a lot of SME employees don't necessarily have that choice at present?
Correct. So I think we would be aiming through our partnership and new solution that we're putting forward to the market today to give members of small and medium-sized enterprises effectively the support and guidance and access that employees of larger firms have long enjoyed. So a step up really in both their capability but flexibility too. So that might be through additional investment options, but it's also through support, guidance and advice services as well.
How much is the typical employee of an SME saving for their pension compared with someone who works for, say, a FTSE company?
Well, I don't think necessarily you can categorise simply between SME. Different employers do different things, and to some degree it depends on the type of industry you're in and how you're paternal. The minimum contributions under legislation is 8%. So, so 1% effectively tax relief, 3% and 4% from the individual. So, that is how the pension contributions at a minimum level are made up, and then it depends whether employers want to make additional contributions over and above that.
Yeah, you've put your finger on a crucial point there, which is that if you work for, say, a FTSE 350 company, the employer is likely to be able to put in more money than an SME owner towards their employee's pension.
Yeah, that's true. It depends, like I say, on each employer, and we're hoping through over time that auto-enrolment contributions get increased, because I think there's a lot of research that says 8% still isn't enough for retirement. So, and I think that the research says that we really need to get to 12% over the coming years. Obviously, at the moment, with the cost of living issue that we've got, that's not appropriate, but I think that's the long-term aim.
There's also then how individuals manage that money. So there's the amount going in, how it is invested and the returns they're receiving, but also then supporting people with education, guidance and advice on how to access their pension when they're finished working. So whilst we've got to get the amount right going in, we've also got to help people make the right decisions. If you get some of those things wrong, there can be quite large tax consequences. Yeah. Some people become high rate taxpayers for the first time in their lives by accessing their pension all in one go. So it's critical they get the impartial guidance and advice to be able to do that and make those decisions.
More broadly, you touched on the cost of living crisis just now. I mean, there have been suggestions that people have been suspending their contributions, in some cases dropping out of workplace schemes, which is a key part of auto-enrolment. You can opt out if you want to. What are you seeing across the economy on that?
So, look, we have seen some people opting out of pensions, but it's a very small amount. So I wouldn't characterise a mass shift of people opting out of their auto-enrolment pension schemes. In general, that piece of policy is really working to keep millions of people saving for their futures. What I would say is those individuals and those employers are seeking to make sure they can demonstrate they're offering value, that businesses are under pressure to retain and attract staff, and making sure that things like their workplace pension offering being up to date and utilising the latest technology and investment solutions strengthens the employer's offers to their employees and helps them with some very real financial planning needs.
Yeah, and just to add to that, we also, we serve over 1.4 million members now, and we haven't seen that drop off in saving. I think probably what we have seen is a slight increase in people claiming, but really contributions haven't dropped off, and that's really a good thing. I think it needs to be a last resort. You won't get a deal anywhere where you effectively double your money through auto-enrolment, through pension savings. So it's a good thing, but we realise the pressures of putting bread on the table, so to speak, for normal working people.
All right, Jamie, Phil, got to leave it there, I'm afraid. Good to see you both. Thank you. Bit of breaking news to bring you that's just reached us. The Israeli military says that an Israeli soldier has been rescued during a ground operation in Gaza. The IDF has tweeted tonight the female soldier, Colonel Yuri Magadish, was released during a ground operation after she was kidnapped by the terrorist organisation Hamas on the 7th of October. The soldier was medically examined, her condition is good, and she met with her family. The IDF and Shin Bet will continue to make every effort to bring about the release of the abductees. Some other business news stories for you now. And General Motors is reported to have reached a tentative agreement with the United Auto Workers Union to settle its long-running pay dispute. It makes GM the last of the big three Detroit-based car makers to settle with the UAW after agreements firstly with Ford and then on Sunday night with Stellantis, the owner of Chrysler. The latest agreements come after 6 weeks of targeted strikes by the union and are said to be based on a 4.5-year deal struck with Ford on Wednesday last week. Shares of McDonald's have risen by more than 1% after the world's biggest restaurant operator reported better sales than expected. The Golden Arches notched up sales of $6.7 billion during the 3 months to the end of September. That was up 8.8% on the same period last year on a like-for-like basis. That's the measure that strips out new openings and refurbishments. Well, McDonald's credited price increases in some parts of its menus, but also highlighted strong sales growth in the UK, Germany and Canada. And the banking giant HSBC has reported a doubling of quarterly profits as it continued to benefit from the impact of higher interest rates around the world. Well, the lender reported a pre-tax profit of $7.7 billion for the 3 months to the end of September. That was up from $3.2 billion in the same period a year ago and reflected a widening in the spread between what it charges borrowers and pays depositors. Well, the performance was also flattered by the fact that a year ago, HSBC took an impairment charge of $3.2 billion related to the planned sale of its retail banking operations in France. The bank said today that this and the sale of its Canadian retail banking operations were expected to be completed during the first 3 months of next year. Well, HSBC also announced plans to buy back $3 billion worth of its shares. Hasn't done much for the stock price, I have to tell you. They've closed down 2.25%. And some 680 workers at Safestyle have been made redundant after the door and window maker went into administration. A further 70 employees will be kept on to oversee the winding down of the business. Well, Safestyle, which is based in Bradford, has a manufacturing site in Wimwell near Barnsley and 42 branches and depots across the country. Interpath Advisory, the administrator, said the company had been hit by various headwinds, including runaway inflation and poor consumer confidence. Now, September's usually a critical month in the jobs market, as it's when the thousands of graduates who left university the previous summer enter the world of work. But a survey published today suggests this summer's graduates will have had a tougher time finding a job than this time last year. The UK job report market report from Adzuna, the job search engine, suggests that there were 23,264 advertised job vacancies for graduates in September, which was down 32% on September last year. That compared with a 6.6% fall in all job vacancies across the UK. The report also points to a modest decline in overall salaries in advertised jobs. The average advertised salary was £37,093, which was up 1.7% on September last year, but down 1.6% on the August figure. Well, joining me now is Andrew Hunter. He's co-founder of Adzuna. Andrew, welcome to you. How do you explain this big drop-off in graduate vacancies?
Afternoon, Ian. Yes, what we're seeing is employers haven't really come back from their summer holidays in a hurry to recruit. As you've said, graduate hiring is down 32% year on year. And this fall in vacancies is particularly concerning, as these will mainly be graduates who were hit so hard as A-level students during the COVID-19 crisis. So we have 23,000 graduate jobs up for grabs, but well over 50 graduates battling it out for every job. So this is one of the most competitive graduate job markets we've seen since we've been collecting data for almost 10 years.
That's extraordinary. 15 graduates battling it out for every job.
50.
50, wow. I mean, that's extraordinary, given that if you look at the economy as a whole, there are around 1.5 job seekers for every vacancy.
That's right. So, and actually, if you look at the entire job market in the UK, there remain 1 million jobs available, and year on year, that's down about 6%. So graduates is one of those industries that's been hit particularly hard this year, with much greater drop-off in hiring, not only from your classic graduate schemes like the Big Four or large banks and technology companies, but we're also seeing it among SMEs as well.
What are the kind of graduates who are finding it easier to find work? Are you able to dig into that sort of detail?
So if you're looking for jobs in teaching, in hospitality and travel, or in healthcare, you're in luck. Those stats and the jobs available are up year on year. So healthcare is an obvious one. There remain over 100,000 jobs up for grabs in the NHS. Now, not all of those are graduate jobs, but plenty would benefit from entry-level workers. And we've seen travel and hospitality return to pre-2020 rates. So folks are more active going on holidays, and that's led to increased recruitment efforts. Every other sector that we monitor is down year on year.
Andrew, is the moral of this that a lot of people are wasting their time going to university and running up lots of debt in the process?
I don't think so. I still think there's benefit in going to university. And, with 1 million jobs on the market, we need to do a better job of training young people with the right skills to fit those jobs. I should add that there was an interesting piece run in the Financial Times last week that looked at the value of a degree and what you get paid these days versus 25 years or so ago in 1997. And I think that premium has dwindled a bit. So UK graduates earned 50% more than non-graduates in 97. And this year it's more like 40%. So having a degree brings smaller rewards in 2023 than it did back 25 years ago.
Yes, I saw that piece. It's a good article. I mean, I guess the point there is that there are more graduates around than there were in 1997 as a proportion of the working population.
I think that's right. This year alone, we're going to see 500,000 new graduates from the plethora of universities across the country enter the market. Now, some of them will be lucky enough to have a job already. Some will want to stay in higher education, but many of those will be hitting this massively competitive job market. And gosh, it's going to be tough for them.
Now, what about advertised salaries? They've fallen month on month. They've snailed up year on year. But I mean, the underlying picture is that they're rising pretty much everywhere apart from London.
That's right. And there was some good news over the summer where we did see average pay growth outpace inflation, but the Adzuna data suggests that that's not necessarily going to continue into September and October. Pay among graduates and in the wider economy does seem to be stagnating as employers put a lid on that pay growth as we approach Christmas. So it's tough times, both from a job availability point of view, as well as from a salary point of view for grads and for folks working across the wider industry.
OK, Andrew, we have to leave it there, I'm afraid. Good to talk to you this afternoon. Thank you. Still to come here on Business Live, we'll have a look at how the markets have done this Monday afternoon. Don't go away.
I'm Greg Milam and I'm Sky's Chief North of England correspondent. We aim to be the best and most trusted place for news.
I'm Helen Ann Smith. I'm Sky's Asia correspondent, and I'm based here in Beijing.
The five of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.
It's like Emirates. It's like better. Fly Emirates. Fly better.
Thank you.
Well, the oil price was down by more than 3% at one point this afternoon as concerns over what the Israel-Hamas war might mean for supplies have continued to ease. A barrel of Brent crude currently changing hands at $88.20 a barrel. That's just shy of 2.5% lower on the session. On the equity markets, European stocks have all finished in positive territory. There's the picture, the IBEX in Madrid grabbing the yellow leader jersey, up by more than 1%. Talking points this afternoon include Erste Group. The Austrian lender is up 3.75% in Vienna on forecast beating quarterly earnings. Well, here in London, the FTSE 100 has also finished in positive territory, half a percentage point better in a broad-based rally. In percentage terms, the leading gainer is Airtel Africa. That finished up 5.25% after its quarterly results were well received. Pearson was another blue chip gainer, finished ahead by nearly 3%. That was after it raised its full-year profit forecast earlier today. There are not too many blue chip fallers to mention, but NatWest has fallen by another 1.75% or so after Friday's disappointing results. Outside the FTSE 100, the specialist information data and analytics company Essential is the leading blue chip gainer. Look at that, finished up 23%. That's on news of two major disposals that will see it raise £1.2 billion. And Premier Foods, that's another one, did an acquisition today. Over on Wall Street, all of the major indices have opened higher, including the S&P 500, which entered correction territory on Friday. All of the mega-cap tech stocks are higher in the US ahead of Apple's results this coming Thursday. On the foreign exchange markets, well, not much to report in all honesty. Sterling finished up, it's currently 1/6% up against the US dollar. It's off by 1/4% against the euro. The single currency, meanwhile, up nearly 2/5% against the dollar. Well, joining me now is Michael Brown, Chief Investment Officer at Martin Currie. Michael, good to see you as ever. Oil price. What's gone on there?
I think traders probably ran in front of themselves here and then stocked up. The reality is that the energy situation is not bad in Europe. We're not short of LNG. We're not particularly short of oil at this point in time. Oil's had a big bounce over the last 2 to 3 months. And I suspect there, with also a warm autumn that we've had, I suspect there's a little bit of, shall we say, common sense coming to play at this moment in time.
Interesting. I mean, the sort of demand-supply dynamics here. I mean, it's all about really. Well, you tell me.
Well, I think oil's probably been used alongside gold as a sort of risk-off asset during this particular period, but actually it didn't make an awful lot of sense. As I say, we'd shipped the LNG in to Europe pretty much. The storages are full. The other swing factor for energy is coal. Coal prices are pretty weak at this point in time. So it's kind of telling you that most people have got what they need for this moment and probably into the winter. And unless it's a brutally hard winter, and I'll leave that one to the weather forecasters, then, actually we're in a better place than we were this time last year. So why should there be pressure on energy prices? And tanker rates are weak at this point. Again, another illustration, perhaps, that the reality is this was a bit of speculation more than anything else.
Now, this is all quite encouraging, Michael. I mean, we've had a really rough 6 weeks or so in the markets. Bond yields going through the roof and so forth. Is this the start of a sort of change of environment?
It feels like it. The first sort of little sign of that with the central banks beginning to go, well, maybe we've done enough. And then we've got, obviously, we're going into corporate reporting season at the moment, which, surprisingly, is a little bit better than people anticipated. If I look around Europe at this point, there's been a little bit of miss on the sales line, but the earnings line, the cash flow lines are much, much better than people anticipated. So if you like, the health of corporate Europe, I think, is much better than we would have thought. So there's that feeling here now that maybe here is a point of stability. And obviously the geopolitics is difficult. Let's not forget that. But at this moment in time, quite a lot of bad news is now discounted in prices. Quite a lot of bad information is out there. You've moved those share prices a bit like we were this time last year. We've moved those bond prices. Actually, are we over-discounting? And I think that's what the market, depending on, if you like, the geopolitical news, I think that's what the market is just touching and feeling today.
Yeah, and I mean, there is scope for positive surprises. I mean, we've got one today from Pearson, for example.
Absolutely.
I mean, that Essential disposal, which has been talked about on and off all year, finally came through today. There is good news out there for those who want it.
And I think you shouldn't forget, the Essential one's really interesting. You've been running a story today about Pizza Express, the holding company for that, having a look at the restaurant group. There is a lot of money in private equity, and it doesn't earn them any money if it's sitting in the bank. There is a lot of opportunity. Yes, interest rates are significantly higher, but there is a lot of money there. There is a lot of opportunity. There are some very, very good prices. You know, we've seen 3 corporate deals today. I think we'll see significantly more going through, and that is the private equity buyers telling us there's value out there, and I would agree with them.
Now, what about HSBC? I mean, the numbers looked pretty good on the face of it. It's one of the few FTSE fallers this afternoon.
Again, ran well into these numbers, so it had a very good third quarter. The market really picked up, if you like, smelt that things were not bad, and that's exactly what you've seen today. Yeah, a little bit of playing on the interest side. Not that worried about that. I think for me, you know, the stock price has moved in advance. It's actually delivered a good set of numbers. Erste Bank's done something similar today. But how much further can it go, given that we're beginning to talk about a peak in rates? We're beginning to look at a fall in rates at this point in time into the next 12 to 24 months. The second thing there, and it's kind of implied, I think, is that the property market in China, saying it's not going to recover, saying there's no stimulus coming to it, is a pretty strong message towards those people who feel that there is exactly the opposite, that actually that could bounce back. So I would say they were significantly more negative about the Chinese property sector than I would have anticipated.
All right, Michael, got to leave it there. Good to see you as ever. Thank you. That's it from me. I'm back tomorrow morning at 11:30 with our next edition. Hope very much to see you then. In the meantime, do stay tuned. Coming up after this short break, it's Mark Austin live in Jerusalem. See you tomorrow. Cheerio. That's great. Of course. Fantastic.
The 5 of us have made it out of the car.
Welcome to Backstage, the film and TV podcast.
It's 5 o'clock. You're watching the News Hour. I'm Mark Austin, live in Jerusalem this evening. Coming up in the next 60 minutes, a breakthrough for Israel as it